Welcome back, and we are almost done with the class. This is going to be our second to last lecture. And in this one, we're going to generalize a lot of what we've talked about. So most of what we've talked about so far has been about what's called a closed economy. And in a closed economy, the economy itself is the only thing we have to worry about. But in an open economy, there are other economies that our economy interacts with. And so there's other things we're going to have to think about here. In particular, exchange rates and trade. Right? These are going to be important issues in what we're going to call international macroeconomics. Right? So now we're not going to be able to assume one single money supply, because all these different countries throughout the world are all going to have their own money supply. How do those interact? And how does that especially interact with the way that these countries trade with each other? So these are going to be some of the questions we're going to ask with the tools that we're going to introduce here at the end. And you'll get a lot more detail about this, those of you who go on to take an international business course or an international finance course. Right? This is just going to be kind of an introduction to some of the things you'll think about in more detail in those courses later. So to start out with, I want to get us thinking about exchange rates, where they come from, how we deal with them, and why we have to think about them in the first place. Right? The reason we have to think about exchange rates is because different currency areas are going to have different money supplies, and they're going to be measured in different units. Right? The Eurozone, for example, is a currency area. Right? So the money supply in the US is measured in dollars. The money supply in Europe would be measured in euros. Right? Different unit, but they're both measuring the same kind of thing, namely value on the margin. And I want us to be precise about how we talk about these things. So very often, those of you who have traveled will have gone and converted, so to speak, your money from dollars into something else, let's say euros. Right? You're not really converting, though. Right? You're not taking your dollars and turning them into euros. What you're doing is you're trading, you're exchanging. Right? And why does this matter? This matters because the money supply of both countries doesn't change when you make that trade. Right? The money supply stays the same. And on the other side of that transaction, there has to be somebody willing to buy that currency from you and to sell you euros. Right? So you're not turning dollars into euros, you're trading them. And now you have some amount of euros, and whoever bought it from you, the bank or the foreign exchange trader, they're going to have more dollars now. So the money supplies in the aggregate don't change, at least not initially. Right? They could have secondary effects that we'll talk about in the next lecture on exchange rate regimes. But in general, the act of trading is not going to change the number of dollars in the economy or the number of euros in the economy. Right? This is going to be a change in demand, not a change in supply. So when you get rid of your dollars and buy euros, you're decreasing your demand for dollars and increasing your demand for euros. And the supply of neither one is going to change. So how do exchange rates get determined? What determines the rate at which you can trade dollars for euros, or vice versa, or any other exchange rate? Well, essentially it's going to be supply and demand, just like anything else. Right? There's a supply of dollars in terms of euros and a demand for dollars in terms of euros and vice versa. And the value of a dollar in terms of euros on the margin, that's going to be the exchange rate. How much the marginal buyer is willing to pay for a euro in terms of dollars. And that's going to be determined by the supply of dollars and the demand for dollars and the supply of euros and the demand for euros. Right? So you're going to have actually four variables now because these markets are two-sided. Just like how the price of goods is determined by the supply of money, the demand for money, the supply of goods, and the demand for goods, right, we're going to have to take account of all four of these things in addition with exchange rates. So let's go back to our schematic diagram here. And we can extend this. Right? You'll notice that this bottom right-hand corner is no longer just foreign exchange, right? But we have a specific currency here. This is going to link two whole economies. Right, so that exchange rate links dollars, which trade against goods, labor, bonds, everything else in the US, it's going to link to another whole economy. And euros are going to trade against their own goods in Europe. They're going to trade against European labor and European bonds. Right, so the market for foreign exchange is really how economies get linked with each other. Right? Otherwise, there wouldn't be any possibility. Because remember that in order to get from one thing to another, if you want to trade labor for goods, for example, you got to go across these arrows. You got to trade through money in order to do that. Similarly with foreign exchange, if you want to buy European goods, you got to trade your dollars for euros and then buy European goods, right? So you can only traverse along these lines, and the foreign exchange market lets you do that, and it gives you access to goods and labor and bonds and anything else all over the world. So the basic concept we're going to be using to talk about exchange rates is what we're going to call the spot exchange rate. And the spot exchange rate is the ratio between the value of two different currencies. Now we're going to have to be a little more precise than that. So if the spot exchange rate is the ratio between two currencies, that can actually be expressed two ways. And in fact, it's going to be perfectly symmetrical. We could express things in terms of dollars per euro or euros per dollar. And anything we say in one direction is going to be true in the opposite direction if we express it the other way. So we're going to have to be very disciplined about how we talk about exchange rates. We're going to have to pick a direction and then stick with it. Because if we waffle between dollars per euro and euros per dollar, then we're going to get confused. And everything we say is going to be maybe the opposite of what's actually happening. So what we're going to say here is that the exchange rate is always going to be from the perspective of what we're going to call a home country. So anytime we're dealing with the exchange rate between dollars and something else, dollars is going to be the currency of our home country because we live in the US. We could do it the other way, right? It's kind of an arbitrary choice, but we have to make that choice and we have to be consistent about it. And this is a way of being consistent. So the way we express this ratio is always going to be domestic currency per unit of foreign currency. And this is going to give us results that are a little different from some of the exchange rates that we see in the financial press. Right, so usually we don't like to deal with numbers that are less than 1. So in common speech, we'll say things like, well, the euro is worth $1.10, or there are 100 yen in a dollar. But notice that these are backwards. Right? The euro is worth more than $1, and so that exchange rate is expressed in terms of dollars per euro, but the yen is worth less than $1, and so that 100 yen is expressed in terms of yen per dollar. So in order to keep things from being confusing, we're always going to keep dollars in the numerator. Right? Because the US is going to be our home country. So the exchange rate with Japan is not going to be 100 yen per dollar. We're going to express that in terms of 0.009 dollars per yen. Right? So we're going to be okay with numbers that are less than 1 in order to make sure that we always have the ratio expressed in the same way and make sure that things are comparable that way. And then euros we can still express in terms of dollars per euro is going to be about 113. So just to emphasize this point, the exchange rate is going to ask the question, how many dollars does it take to get a euro or some other currency? Right? So dollars per euro is a different question than how many euros can I get for $1? And that would be euros per dollar, right? That would be reverse. That would be the exchange rate if Europe were the home country, right? So if you're taking this class in Europe, right, you'd flip everything. And as long as you're consistent, that's okay. But this is just a way of helping us to be consistent in that choice. So let me walk through some examples of what we can do with exchange rates and how we deal with them and why it's necessary to deal with them. All right, so suppose you want to buy something from France and you try to offer them dollars. But what's a French guy going to do with dollars, right? He doesn't want those. He can't spend those. So he's going to say, no, right? I'm going to want euros. And so in order to buy from him, you're going to have to take your dollars and buy euros. Remember, you have to traverse those lines in our diagram. So very often this is kind of transparent to you, but this is happening behind the scenes when you purchase something from abroad with your debit card, for example. Your bank is going to be exchanging currency behind the scenes for you. So that being the case, you're going to want to know how many euros can you get for $1? And how much would it cost you in terms of dollars to buy something whose price is expressed in euros? So let me give you a few examples here. If you want to buy a 10 euro wheel of cheese from France and have it shipped to you, you're going to want to multiply the euro price by the exchange rate in order to find the price to you in terms of dollars. So here's how this would work. If this wheel of cheese is 10 euros and the exchange rate is $1.13 per euro, what you're going to do is you're going to multiply 10 euros, the price, by $1.13 per euro, the exchange rate, and that's going to give you $11.34. Note that the euro unit cancel out because it's in the denominator in the exchange rate, and then the unit left over is dollars, and you get a dollar price. That's going to be $11.34. If you want to go the other way, and let's say that you're selling burgers, and somebody in France wants to buy a burger from you, how many euros should you ask for? And in order to find that out, you're going to want to divide by the exchange rate. So again, our exchange rate is going to be 113.4, and let's say your burger costs $12. You're going to divide that $12 by the exchange rate, and notice what happens to the units here. The dollars are going to cancel out, and euros are going to move to the numerator. And that's going to be your unit, right? This is going to give you a euro-denominated price. That's going to be 10 euros and 58 cents. Now, a lot of people get confused here, and it's hard to keep straight whether we multiply or we divide or what are we doing here. And the way you keep this straight is by keeping track of the units. Remember, throughout this whole semester, we've been very scrupulous about making sure our units match and making sure we carry through the units. And that's going to really pay off for us here, because this is how we're going to anchor everything. Because we can look at things from either perspective, from the US perspective, from Europe's perspective. And so keeping track of the units is going to anchor us and make sure we're doing everything in the right direction. So you know the currency you're starting with, and you know the currency you want to end up with. And if you carry through the units correctly, you're going to know whether you need to multiply or divide, as long as you remember that the home country's currency goes in the numerator. Right, suppose you did things wrong in the cheese example. Suppose you have a 10 euro wheel of cheese and you accidentally divide by the exchange rate instead of multiplying. So you take 10 euros, divide that by $1.13 per euro. But what units does that give you? Right, euros divided by dollars per euro. That's going to put dollars in the denominator, and then you're going to get euros squared in the numerator. What's that? Right, that doesn't make any sense. So if your units don't cancel, you know you did it wrong. Right, so this is why it's important to remember that the home country always goes in the numerator, because that's going to anchor you and make sure that you're doing everything in the correct direction. So now let's talk about changes over time. Right, we've distinguished between levels and rates of change in the past, especially with the price level. Right? The price level is some number, and the rate of change of the price level is inflation. We're going to have exactly the same distinction with the exchange rate. Right? The exchange rate, the spot exchange rate, is what we're going to talk about at a single moment in time. But when we talk about rates of change in the exchange rate, we're going to be able to talk about appreciation and depreciation. And just like inflation and deflation refer to a rate of change of the price level, appreciation and depreciation are going to refer to rates of change of the exchange rate. Now, this is where things get a little confusing sometimes. So appreciation means that the exchange rate is going to fall. Now, that might sound a little confusing at first, but it makes sense if you think about it. Right? So appreciation of a currency means it's getting more valuable. And if the dollar is getting more valuable, then the number of dollars that it takes to buy 1 euro is going to fall. Right? So where before it would take $1.3 to buy a euro, and now it takes $1.1 to buy a euro. Right? The exchange rate has fallen, but that means that the dollar has become more valuable. That means that the dollar has appreciated. And on the other hand, a currency depreciating means that it's becoming less valuable in terms of another currency. And just like appreciation means the exchange rate falls, depreciation is going to mean that the exchange rate is rising. For exactly the same reason. If before it was taking $1 to buy a euro, but now it takes $2 to buy a euro, the exchange rate has gone up, that ratio has gone up, but that means that the dollar is now less valuable. Right, so don't get confused. Always be careful about what's rising and falling, and don't try to memorize this. Right? Don't try to just memorize a table of what relates to what. Always remember the logic of it and be able to work out the story of why it's the way it is. Right? Because that's going to be the most important thing for you in the long run. Right? If you can tell yourself a story about what it means for that ratio to rise or fall, then you're going to be able to keep straight whether that means appreciation or depreciation, and whether you should multiply or divide, or any number of these other things where whether it rises or falls depends on the perspective that you take. So again, the home country's currency being in the numerator is going to anchor us, and as long as we start there, we can extrapolate, and we can tell a story that makes sure that we relate these quantities to each other in the correct direction. And one last thing too, is that the ratio is relative. And so if one currency depreciates relative to another, the second currency is going to appreciate relative to the first. Right? Because the ratio falling from the perspective of one country means that the ratio is rising from the perspective of the other country. Right? You're just flipping that fraction. So let's go through a couple examples, and be sure to pay attention here to the units that are being reported here. Because even though we're going to be consistent about home country currency in the numerator, if you go on, let's say, Yahoo Finance or something like that, they're not always going to be consistent. And so you're going to want to be able to translate and know when you have to reverse everything. So this is the exchange rate between euros and dollars from 2011 to 2015. And given that we're looking at numbers like 1.1 to 1.4, is this going to be euros per dollar or dollars per euro? Well, this is going to be dollars per euro. Right? So this is going to actually be correct from the perspective that we want to take. Right? So our home country is going to be in the numerator. So in this period of time, in 2012, right, because our units are correct, we can say this refers to the exchange rate falling. And if the exchange rate is falling, that means the dollar is appreciating. Right? The dollar is getting more valuable because it takes fewer dollars now to buy 1 euro. We've gone from it taking 1.27 to about 1.15, let's say. So the dollar is appreciating relative to the euro, which also means that the euro is depreciating relative to the dollar. Now it takes more euros to buy $1, or you can buy more euros with $1. And finally, because the units have the home currency in the numerator, this graph is tracking the actual exchange rate. Over here, right, we have the exchange rate rising, which means that the dollar is depreciating. Right, now it takes more dollars to buy 1 euro. We've gone from about 1.25 to about 1.4. Right, so the dollar is getting less valuable relative to the euro, and the euro is appreciating. Right, the euro is becoming more valuable. You can now buy fewer euros with $1. And the exchange rate here is rising. So notice the terminology here. Right, currencies are going to appreciate or depreciate when they become more or less valuable, but exchange rates are going to rise and fall because exchange rates are just those numbers, right? Currencies are not just numbers. Currencies are units. They can become more or less valuable, but the exchange rate being an actual number is going to be something that can rise or fall. Here's another example. This is the exchange rate between Japanese yen and US dollars. Now look at the vertical axis here. Given that we have numbers like 120 or 100, is this going to be dollars per yen or yen per dollar? Well, this is actually going to be yen per dollar. And this is how it's very often reported in the financial news, again, because people don't like to deal with numbers that are less than 1. So because this is yen per dollar, we're going to know that anything in this graph we're going to have to reverse in our minds. right? Because this is putting the home country in the denominator. So this would be the exchange rate from Japan's perspective, for example. And over here, right, if yen per dollar is rising, then that means the number of yen you can buy for a dollar is going up. The dollar is getting more valuable, right? So the dollar is appreciating here. And the yen, on the other hand, is depreciating. The number of yen it takes to buy a dollar is increasing. And so this plot is not actually the exchange rate from our perspective, right? From our perspective, this would actually be the inverse of the exchange rate. And so the exchange rate is going to be falling. Right? If the inverse is rising, the actual exchange rate is going to be falling once we put the home country in the numerator, as we're going to want to do to be consistent. Down here, it's the opposite. Right? The inverse of the exchange rate is falling, which means that the dollar is depreciating. Right? If yen per dollar is falling, that means that the dollar is getting less valuable now. And it takes fewer yen to buy $1, so yen are going to be appreciating. And so again, because this is the inverse of the exchange rate, the inverse falling means the exchange rate is going to be rising. So the reason I point this out is not to confuse you, but to make sure that you don't get confused when you see graphs like this in the financial news. Right? Because if you see the dollar going one direction with respect to the euro and the other direction with respect to the yen, right, you're going to want to know, do I need to flip one of these to tell a coherent story here? And very often the answer is going to be yes. So keep that in mind and don't get confused, especially as you take these concepts out into the real world. So the next thing I want to introduce here is this idea of purchasing power. And the idea of purchasing power is going to ask, what if my dollar goes farther in one place than another? Right? Maybe the true value of the currency is not the rate at which it exchanges against other currencies, but the goods and services that you can buy with that. Right? And just like we've talked about real prices and real incomes and real GDP, right, that's going to be a sensible question that we can ask. Right? So here's a map of differences in purchasing power in the US. And you can see here that you need about $120 to do in New York City what you could do for maybe $80 in South Dakota. Now, what's the exchange rate between North Dakota and New York? Well, the exchange rate's going to be 1, right? A dollar is a dollar in both places, and that ratio is just going to be 1. But even though the exchange rate is 1 for 1 between these two places, that money's still not going to go as far in one place versus another. And remember, we've talked about why this might be a surprising result, right? We'll come back to that later on. So this can also be true between countries and not just within countries. For example, if you go to Switzerland, nominal prices in Switzerland are pretty close to nominal prices in the US. So I can get lunch here for about $12 if I wanted to get a chicken salad or something. Now I can also get lunch in Switzerland for about 12 francs. The problem is that the franc is worth a lot more than the dollar. So with the exchange rate, that 12 franc lunch cost me about $16. Right, so even though the nominal prices are similar, the exchange rate is such that I'm actually paying a lot more in Switzerland than I would be in the US. So my money, regardless of it being in a different currency, my money's not going as far, and my cost of living is higher in Switzerland than it is in the US. And to account for these differences, we're going to introduce something called the real exchange rate. Just like we have nominal prices and real prices, we're going to have nominal exchange rates, the spot exchange rate, and real exchange rates that are going to account for how much you can actually do with your currency, how many goods and services you can actually afford. And in order to do this, we actually have to take account of the price level of both currencies. Right? And the way we do that is going to be, instead of dividing dollars per euro, we're going to divide real dollars by real euros. Right? So we can't just take the exchange rate and divide it by the price level, right? Because we have two price levels to deal with. But because the exchange rate is a ratio between two currencies, we can incorporate both price levels by dividing, instead of just the currency units themselves, we can divide real currency units. So real dollars divided by real euros. In this formula here, P star is going to refer to the foreign price level. Right? That's a very common convention in international macroeconomics. Right? So P star is going to be the price level in Europe, and P is going to be the price level in the US, in our home country. And so this formula, real dollars divided by real euros, this actually simplifies into a formula that you'll sometimes see in textbooks, which is going to be the exchange rate times the foreign price level divided by the domestic price level. Now, how do you keep track of whether you have the foreign price level in the numerator or the denominator and which goes where? Right, the way you keep track of that is from this first formula up there. Right, you're going to be keeping track of real dollars divided by real euros. And then that's going to simplify to this formula you sometimes see elsewhere down here. Right, but you're always going to be dividing dollars by the price level in dollars. And you're always going to be dividing euros by the price level in euros. And again, that's going to anchor you. That's going to help you keep track of which goes in the numerator and which in the denominator. As long as you remember that the home country currency always goes in the numerator, you'll be able to keep track of this if you remember the logic of how to get there. So what does this tell us? This tells us that for a constant exchange rate, if we keep the ratio between Swiss francs and dollars constant, if prices rise in Switzerland, and so their currency now goes less far, its real exchange rate is going to be higher, which means that its real value, in terms of what you can actually buy in terms of Swiss francs, is going to be lower. Now here's a fun example of what we can do with real exchange rates. So the Big Mac index is something that was invented by The Economist magazine in 1986. And what this does is it's going to assume that the price of a Big Mac reflects the average price level in a country. Now what's this doing? Essentially what this is doing is it's building a price index out of a basket of goods that has one good in it. And that good is a Big Mac. And as it turns out, a Big Mac is actually fairly representative of prices in general. And so the Big Mac index asks, how affordable is a Big Mac in any different currency? And that's going to be a proxy for trying to get at what's the cost of living in various different countries. And you can use this as kind of a quick and dirty way of calculating real exchange rates. So if you convert the price of a Big Mac in any different country, if you convert that back to dollars, you can see which countries have overvalued currencies versus undervalued currencies at the current exchange rate. So up here you can see that Swiss francs are pretty dramatically overvalued. What does that mean? It means you can't buy as much with them at the current exchange rate. And on the other hand, the Korean won at the bottom down there is pretty undervalued, which means you can buy more Big Macs with them at the current exchange rate. So one practical way of using this is to ask, how good of a deal am I getting if I want to take a vacation to, let's say, Switzerland or South Korea? And the fact that Swiss francs are overvalued means that tourism to Switzerland is going to be a pretty bad deal, right? You're going to buy Swiss francs, and those Swiss francs aren't going to go very far. On the other hand, if you wanted to take a vacation to South Korea, the exchange rate is undervalued, and that means you're going to get a really good deal, right? You're going to be able to buy enough Korean won that you're going to be able to buy things there pretty affordably. And this gives us a sense of how changes in exchange rates affect the profitability of imports and exports. So from the perspective of Switzerland, because their currency is so overvalued, they're going to be able to buy a lot more of other people's goods. But it's going to be a lot harder for them to sell goods to other countries because the prices are so high in relation to the exchange rate. And the opposite is going to be true for South Korea. If their currency is undervalued, it's going to be really hard for them to import from other countries because their money's not going to go very far in other countries. But other countries' money is going to go very far in South Korea. And so Korean exporters are going to do really well. And this has actually been kind of a deliberate strategy of not only South Korea, but also a lot of the East Asian countries that have done really well in the past few decades. Right? They've undervalued their exchange rate in order to encourage exports and to make it cheap for people outside to afford the goods that they're sending out. this has the cost of making it difficult for them to afford goods produced by other countries. So there's definitely a trade-off there. And you can think of this as kind of a subsidy to exporters. Right? The average Joe is going to be less able to afford imports from the rest of the world in order to make sure that exporters do well. Right? So kind of a tax, kind of a transfer from consumers to exporters. And the opposite in Switzerland. Right? In Switzerland, you have exporters kind of transferring resources to consumers. Right? Consumers can import just fine, but Swiss exporters are going to do very poorly, let's say. So let's do an example here. Suppose you can buy 2 pesos for $1. Now that being the case, what's the exchange rate between the peso and the dollar? Is that going to be 2 or is that going to be 1/2? Well, the exchange rate is going to be dollars per peso. So how many dollars is it going to take to buy 1 peso? Well, it's going to take $0.50 to buy 1 peso. And so the exchange rate is going to be 0.5, right? Because again, our home country currency is in the numerator. Now suppose that a Big Mac is $5 in the US. And in Argentina, you can get a Big Mac for 8 pesos. Now, at an exchange rate of $0.5 per peso, how expensive is that Big Mac in Argentina if you convert that price back to dollars? Well, that's going to cost about $4. Right, so what this tells us is that the cost of living, on average, if the Big Mac is about average, the cost of living in Argentina is lower than it is in the US. So if we do like the Big Mac index, and we say the price of a Big Mac is representative of the price level, what we can do is we can take the exchange rate, 0.5, multiply it by the price of a Big Mac in Argentina, divide it by the price of a Big Mac in the US, and that's going to give us a real exchange rate of 0.4. The fact that the real exchange rate is below the nominal exchange rate tells you that cost of living in Argentina is somewhat lower than it is in the US. If it was the other way around, if let's say the price of a Big Mac in Argentina was 12 pesos, that would be $6, and then you'd have a real exchange rate that's higher than the nominal exchange rate. So now let's think about this from a broader perspective over time. And imagine 2 different countries with a nominal exchange rate of 1. Where are 2 places with a nominal exchange rate of 1? Right, we've just seen an example, New York and South Dakota. Right, use the same currency, and so any 2 places with the same currency have an exchange rate of 1. But now suppose that prices are twice as high in New York as in South Dakota. So even though the nominal exchange rate would be 1, this would give us a real exchange rate of 0.5. Now think back to homework 2 and the last question on it. If there are cost of living differences, that's a surprise, right? Why is it a surprise? Because if you can trade between South Dakota and New York, and if prices are lower in South Dakota than in New York, what are you going to expect to happen? Well, the law of one price tells us that we ought to expect arbitrage. And arbitrage is going to equalize those costs of living. Right? So in the case of New York and South Dakota, if prices are low in South Dakota is going to be able to make more money by exporting to New York. And New York's going to be able to get cheaper goods by importing from South Dakota. And so that being the case, supplies are going to increase in New York and prices are going to fall. And supplies are going to decrease in South Dakota, prices are going to rise. What this price differential is doing is that it's signaling that on the margin, these goods are more valuable in New York than they are in South Dakota. And so imports and exports are going to equalize those prices. Right? The same process that we can imagine happening between states, we can also imagine happening between countries. And the fact that they have different currencies shouldn't really matter as long as they can trade and exchange currency freely. So we ought to expect these differences between the real exchange rate and the nominal exchange rate, we ought to expect those differences to go away. And that expectation is going to give us a theory called purchasing power parity. And purchasing power parity is one of the oldest theories of exchange rate movements. And this is essentially going to be a law of one price across countries. And the implications of purchasing power parity come entirely from this arbitrage story. Right? If your currency is overvalued, let's say Switzerland, you're going to want to import more and export less. And that's going to cause prices to fall in Switzerland and prices to rise elsewhere. And that's going to cause the real exchange rate in the long run to move kind of in line with the nominal exchange rate. By the same token, the Korean won. If their currency is undervalued, it's going to be difficult for them to import, but really profitable for them to export. So they're going to lose goods. Right? Goods are going to leave the country, so prices are going to rise in the home country and fall in the foreign country. That's going to, again, re-equalize prices between the foreign country and the home country, and you get a real exchange rate again that's more in line with nominal exchange rates. So the prediction of purchasing power parity is that either price levels or exchange rates are going to move such that there are no arbitrage opportunities anymore. Either prices are going to fall in Switzerland or the exchange rate is going to move to where you can't arbitrage that anymore. Same thing for South Korea. Either prices are going to rise or the exchange rate's going to fall. And the end goal of this arbitrage is that arbitrage opportunities are going to be eliminated in the long run. Right? Just like our law of one price story, this is also going to hold between countries. Let me give you a concrete example of this. Suppose you can buy a laptop for $1,000 in the United States. And again, let's suppose we have a nominal exchange rate with Argentina of $0.5 per peso. If purchasing power parity holds, how expensive is that laptop going to be in terms of pesos? Well, what we're going to do here, we have a dollar price. We want to get to pesos. So we're going to divide the dollar price by dollars per peso. So $1,000 divided by 0.5, that's going to give us 2,000 pesos. And if that costs 2,000 pesos in Argentina, then purchasing power parity holds. If, on the other hand, it costs some other amount, suppose it costs $1,000 in the US and $1,800 in Argentina, there would be an incentive for the US to import that cheaper computer from Argentina until those prices equalized. If it was 2,200 pesos in Argentina, there would be an incentive for Argentina to import those computers from the US, again until those prices equalized. That's the purchasing power parity story. Right? So purchasing power parity tells us that once you convert the exchange rate, in the long run, we're going to expect any kinds of goods that you can trade to be the same price across countries, just the same as we have a law of one price within countries. So the implication of purchasing power parity is that the price of money in terms of goods ought to be changing at the same rate as the price of money in terms of other currency. Right? So there's several ways that we can talk about the value of money, right? Because money doesn't have its own price because prices are quoted in terms of money. So if we want to talk about the value of money, we have to talk about the value of money in terms of something. And we can talk about the value of money in terms of goods, in which case we have the purchasing power of money, right, the inverse of the price level, or we can talk about the value of money in terms of other currencies, in which case we have the exchange rate. And purchasing power parity tells us that the value of money in terms of goods ought to track the value of money in terms of other currencies. Right? So if the value of money is falling, it's going to be falling in terms of goods, and it's going to be falling in terms of other currencies. And if that's not the case, that might imply an arbitrage opportunity. And we can also express this in terms of rates of change. Right? So the rate of change of the price level ought to track the rate of change of the exchange rate, at least relative to the inflation rate of the other currency. Right? So in equilibrium, if a currency is inflating at 2% a year, right? So goods are getting 2% more expensive every year, it ought to be depreciating at a rate of 2% a year as well against other currencies that don't have any inflation. So let's look at this in terms of our schematic diagram. Right? Suppose the supply of money goes up. Money becomes less scarce. The price of goods is going to go up. Price level is going to go up. That's inflation. And the price of foreign exchange is going to go up too. That's going to be depreciation. Right? And we can also see in the background the same thing happening in the other two markets as well. Wages are going to rise, interest rates are going to fall temporarily, price of bonds is going to rise. So arbitrage, to the extent that it's effective, is going to make sure that all of these are happening at about the same rate. Now let's talk about some evidence for and against this. Right? Because we've seen the law of one price is something that is pretty safe to assume in most cases, but not foolproof. Right? There are certain instances where the law of one price is not going to hold. For example, remember transportation costs. And we can imagine similar sorts of things getting in the way of purchasing power parity. So one thing we're going to want to know is how well does purchasing power parity hold up as a theory of exchange rate movements? Well, here's some evidence for it. This is a graph of the hyperinflation in Zaire in the 1990s. And the solid line tracks the price index, and the dotted line tracks the exchange rate. And what you can see is that these track each other really closely. And so this is one of the best pieces of evidence for purchasing power parity, is that if you get major disparities, like in a major inflation, if prices are going up at a good clip, your exchange rate is going to be rising at that same clip. Right? Arbitrage is going to make sure that major differences go away pretty quickly. And your inflation rate isn't going to be able to get too out of line with your exchange rate. Now, there's also a good bit of evidence against purchasing power parity as well. And we've seen this map already. Right? And this map you can think of as evidence against purchasing power parity in a lot of cases. And if it's the case that differences in cost of living don't go away between two regions that share the same currency, right? They're probably somewhat less likely to go away in regions that don't even share the same currency. So even though major differences in purchasing power parity go away really quickly, right? If you have a hyperinflation or even a moderate inflation, arbitrage is going to equalize those pretty quickly. But minor differences, those are going to be somewhat persistent. And if you remember from homework 2, that last question, this is going to be somewhat surprising, right? We're going to need to explain why these differences in prices don't get arbitraged away, because you'd think there's money to be made by doing that. But for some reason, there doesn't seem to be. Why not? And any answer we give to this question, just like the answer to the question why price differentials between cars don't go away between New York and Texas, right, we have to answer, what is it that's preventing people from arbitraging that price difference? Right? We can't just assume that there's an opportunity here that nobody's taking advantage of. We're going to have to actually figure out what is it that's preventing people from taking advantage of these price differentials. And you can imagine a few different kinds of answers. One of these might be tariffs. Right? If there are tariffs, which are taxes on imports or exports, right, or trade barriers. If I want to import something from China, and there's a tariff, and I have to pay extra taxes on top of that, right? Even if the price is lower in China, the price I'm paying, including the tariff, might not be any lower than the price in the US. And so tariffs are going to prevent those price differentials from going away. Essentially, they're preventing trade from equalizing those prices and preventing those positive sum trades from being made. Now, are tariffs going to constitute the whole explanation? At one point in history, maybe. But since the 1970s at least, tariffs have gotten pretty low worldwide, and average tariff rates are a very small fraction of import costs. And this is what's allowed supply chains to become so globalized over the past few decades, since the 1970s. And this has brought a lot of benefits to consumers and to the global economy's ability to satisfy needs with the resources that it has, and by allowing countries to specialize according to their comparative advantage. So the fact that supply chains have become so globalized suggests that maybe the answer isn't really tariffs, right? Because tariffs are going to prevent that sort of globalization. And tariffs aren't going to explain within country differences either. Right? They're not going to explain the difference between New York and South Dakota because there's no tariffs between different states. Right? All the states in the US are a free trade zone. And so those kinds of barriers aren't going to be able to explain why cost of living differences within the US don't go away. Another example would be non-tradable goods and services. Right? One example of this would be haircuts. Right? It makes sense that you'd have a law of one price with computers, right? Because computers are easy to ship from one country to another or one state to another. But a haircut, that's a little harder. Right? You kind of have to be on site for that. So it's difficult for countries to export services. And so that might be a source of cost of living differences or purchasing power parity differences that don't go away. Another thing that I mentioned briefly with respect to that question in homework 2 is land. A country can't really export its land or import any land. Right? So if there's land in one country that's more in demand than another, or land in a city that's more in demand than, let's say, a rural area, that can lead to persistent cost of living differences just because you can't arbitrage away those price differentials in land. Right? So non-tradable goods and services, to the extent that those make up a big portion of GDP, those can prevent purchasing power parity from reasserting itself. Those can lead to persistent differences in purchasing power. Another example might be transportation costs. Right? Just like in the last question of homework 2. If it's costly to take advantage of those arbitrage opportunities, if it costs some money to ship things from China to the US or vice versa, that can actually give exchange rates some wiggle room around purchasing power parity to where maybe it's not worth it at a slight difference to arbitrage it. But at a big difference, it might be. One final possibility is just timescale. Maybe it takes a long time for people to take advantage of these for whatever reason. Right? Maybe because of regulations, maybe because of it just takes them a while to notice, or maybe there's some investments that have to be made in order to get into the market. Right? So it might be the case that purchasing power parity is a good theory of the very long run, but maybe not so much for the short run. Right? Maybe it just takes time for this arbitrage to happen. And there's some good evidence of this. Right? Over the course of years or even decades, purchasing power parity seems to predict motion in exchange rates pretty well. What do you do on a day-to-day or month-to-month basis? Well, that's going to be maybe a different question. So any of these kinds of costs of trade, any of these kinds of transaction costs, of which transportation costs would be an example, are going to give you kind of a band around purchasing power parity. So let's plot time on the horizontal axis here and the exchange rate on the vertical axis. So this is plotting the exchange rate over time. And this solid line in the middle, we'll call that purchasing power parity. If the exchange rate is on that line, then there's purchasing power parity and the law of one price holds, and the cost of living is going to be the same in both the home country and the foreign country. The effect of transaction costs, like transportation costs, or like tariffs, or any of these other things, the effect is going to be to give some wiggle room around that purchasing power parity. So if you move outside that band, it's going to be profitable either to import or to export, and to arbitrage that price difference if it becomes big enough. And that's going to push you inside the band. Right? So if the exchange rate rises enough, if your country undervalues its exchange rate enough, it's all of a sudden going to be profitable to start exporting goods. Right? Because other countries are going to be more able to afford your cheap goods because your prices are too low for the exchange rate. And so people start arbitraging that and exporting goods. That's going to push the exchange rate back within the band. If the exchange rate gets too low, if the currency is overvalued, then your consumers are going to be able to afford to import more. And they're going to import more goods, try to arbitrage that price differential, and that's going to push the exchange rate back up, right, within that band. But as long as we're within that band, as long as we're not too far away from purchasing power parity, right, it's really not profitable to import or export, right, because you're going to be incurring more costs by doing that than you get in terms of profits. And so arbitrage isn't going to push you back to purchasing power parity as long as you're within that band of transaction costs. So the question we want to ask is, how wide is this band? Right? How big are transaction costs? Because the bigger they are, the more wiggle room you'll have around purchasing power parity. So I'm going to go ahead and end there. And in the next lecture, which is going to be our final actual lecture, we're going to pick back up and talk about exchange rate regimes. Right? Or in other words, what are different ways that countries can set up their exchange rate system. And that'll give us a way of talking about especially exchange rate crises and what happens to trade and growth when a country is not able to maintain its exchange rate. All right, so I'll see you then, and have a good afternoon.